8-9 years ago, people didn't even understand what a family office meant. So how did you go about learning how to set up a family office?
Family office is far more than just sitting and figuring out which investment you want to put into. Now we were talking about the hard-earned wealth that had been created by the family over the last 30-35 years. It was a fairly large responsibility of someone even my age then to come out and say, this is how much you want to put in equity, in debt, in cash.
Tell me a little bit about the mistakes that you learned and tried to avoid while building your family.
First, figure out what your real risk appetite is and what you really want from the capital. Another mistake is one size fits all. It just doesn't work like that.
When a wealth creator or the promoter sees drawdowns in their portfolio to the tune of 30-40%, what was that experience like for you?
2014, there was a lack of stability in the market, and then 2018 January, mid and small caps had a large drawdown. So 2014, the reaction was more like, what the hell just happened? Is this normal? Should this be happening? 2018, the reaction was, okay, looks like things were a bit heated up, so this was gonna happen. 2020, COVID was a real test. That time, surprisingly, we had stopped reacting. So it started from a cycle of overreacting, reacting to now being numb.
In the last 2-3 years, your small caps and mid caps gave 30-40%. So which funds in the private space were meeting that criteria, right? So then how does one decide when one should do private versus public?
Well,
hello and welcome everyone to the India Opportunity Show. Our guest today is Yash Poddar, the Chief Investment Officer at Vikas Poddar Family Office. Viansh Ventures was actually one of the first few family offices that has been leading the way and showing others how to set up their own family offices. Anyone who wants to establish their own family office or is running their existing family office will be able to learn a lot from Yash's experiences. He shares very candidly about his mistakes, learnings, and journey along the way. And also all the meaty stuff that you usually never get to hear externally. Hope you enjoy watching. Hi Yash, welcome to the India Opportunity Show.
thank you for having me, Shrishti.
Thank you for giving us this beautiful office to shoot in today.
Well, I'm glad that we are here and it's happening.
Yeah, me too. Let's talk about, your family's journey into establishing a family office, because you were the person to set up the family office. First, any family, when they go through a liquidity event, when something big happens in the family, like an M&A event, which was true in your case, there's a lot of operational shift which happens. Mindset has to shift, and a lot of things change in terms of dynamics between the family members and what the next gen will do. So tell me about your experience of those days. How did you figure out that this was the right time for us to start a family office?
Yeah, definitely. So growing up in a business family, we are often accustomed to the fact that business means what you've been doing for all these decades and years. So growing up for me in an environment where manufacturing and pipes were the only two things we spoke about basically 12 hours a day, to now think about looking at investments from an allocation standpoint was a completely new and a rewarding experience as well. Personally, in my front, I had always been far more passionate about financial markets and investments. So it was also serendipitous that it came. A situation emerged where I could practice my skill and practice what I had learned. But one of the biggest challenges that we faced in that time was, as a family, when you're transitioning from something that you have been doing to now suddenly becoming asset allocators, where you're not necessarily operating things 24/7. And oftentimes, a lot of the investment performances are not in our control. That was a very huge psychological shift. Having said that, having seen a business setup, the idea was to replicate a good set of systems and processes which can be applied to our single family office. The goal behind that was simple. Can we run this as professionally and as automated as possible as we were running the previous business? But now, of course, it's with personal wealth rather than a business wealth. But at the same time, keep the sensibilities of a family and marry those sensibilities to certain principles that we are able to agree upon for the long-term growth of the family.
Yeah. But, we both started our family offices at a time where it wasn't so common. Like last 2-3 years, there's been an emergence of family offices in India. But I remember 8-9 years ago where I set up my family office, people didn't even understand what a family office meant, right? And you had to explain the concept to people. So how did you go about learning, how to set up a family office? I'm sure, in my case, I had to look to the West a lot and learn from them. What was your experience?
very similar to yours. I have to add that I still have to explain to a lot of people what a single family office is. That becomes quite the task. But jokes aside, when we began, 2012 was the year that we knew that the joint venture was going to happen. So my first reflex to that was, okay, let's go out to the market. Let's meet people and understand what's going on. Family office events today have 200, 300 people attending. 2012, I would be lucky if I saw more than 25 people in a hall, where everybody was sitting on the stage and discussing, okay, how are they investing? What assets are they looking at? And there was also very, very few opportunities to engage with such people. So whatever little opportunities came along my way, I would take them. And there were few events in Bombay, I remember, where I managed to go and begin the interactions. So that really got me thinking. So to be frank, I don't think I had all the answers on day one at all. It was quite a learning curve for me as well. But what we tried to do was try and figure out what the best practices are. So in India, there were few FOs that had been set up in the early 90s and 2000s. And so through our networks and people, we were trying to figure out, before figuring out what good they have done, what mistakes have they made so far? What kind of mistakes do families make? So there were a few books that came across at that point of time to us. One of which is called Family Capital, which talks a lot about the mistakes that large family offices make and they lose money. So my dad suggested to me that before learning what to do, first learn what not to do. And so I took that as an advice. And at that point of time, we had to Google what a family office meant. Even we had no clue about what this word is, what it really means. Initially, we thought it was only investing. But well within 2013, by the time the liquidity came in and we had to seriously think about it, we realized, Shrishti, that family office is far more than just sitting and figuring out which investment you want to put into. Because now we were talking about the hard-earned wealth that had been created by the family over the last 30, 35 years. And so it was a fairly large responsibility of someone even my age then to come out and say, okay, this is what we're going to do with it. This is how much you want to put in equity, in debt, in cash. So as you can imagine, for the family, it was not easy. Seeing hard-earned wealth suddenly now going out to 4, 5 different avenues that even you are not sure of risks about. So very quickly I learned that risk assessment becomes very important. And that is generally what I would say the first phase of learning taught me. And then second phase taught me more about the art of elimination and the art of figuring out who we want to work with. So I would say roughly this is the 2 ways that we followed.
Yeah, I think that's a very common theme that I've heard from a lot of people also. Unfortunately, a lot of people get it wrong in the first few years a lot. And we've all been privy to those conversations as well. So tell me a little bit about the mistakes that you learned and tried to avoid while building your family office.
Certainly. So one of the mistakes that I would like to look at as a lesson today for us is first figure out what your real risk appetite is and what you really want from the capital. Because what tends to happen is, in our financial markets, family offices are still viewed as an avenue to sell various products and services to, without really always knowing what they want. So one of the mistakes that is good for everybody to learn from is first introspect and figure out what you really want, and only then go out to the market or the sell side and say, okay, look, this is my mandate. And another mistake that I feel that family offices can make is one size fits all. It just doesn't work like that. My inspiration when I was setting up the initial FO framework was to think of how would large pension funds and institutional funds think, or large sovereign funds think when they're allocating capital for the next 30 years. So that became the bedrock of my thought. And very quickly I realized that it's not possible for us to use the same framework as them, or even a family office which could be down the road from us. Very different people and emotions involved. So we really tried hard to keep it unique to ourselves. So which meant immediately that you needed to stop comparing what investments you're doing versus what somebody else might be doing, and stop going to parties where people are talking about, I got this return and I got that return. We started to avoid those conversations.
But that's so hard to avoid. It's literally every conversation that you have these days.
So true. So now we're actively avoiding them because end of the day, if you're investing because of FOMO, then you're not an investor. You're just a follower. And through my interactions in places like Mumbai, Delhi, and Bangalore, I started to realize that the best thing is to be very quiet about your work, invest in what you understand, and just move on. Because look, you are going to interact. We are in the social world, but how much you want to interact and what you want to talk about is something that you could control.
Yeah, because I'm very surprised by how some of the deals come together, right? Like it's like one person decides that they want to do it, and then 2-3 other people decide and fill up the round. Unfortunately, that is FOMO and herd-based mentality that people are following. So what are some things that people should avoid in the initial few years when they're getting started? Because one would also argue that, you ride on with other people and, co-invest so that, you don't make the mistakes that other people are making. So how should one think about that and find a good balance for themselves?
So from an asset allocation standpoint, what one should do is first sit down with your family, and this is to all the wealth creators. First, sit down with your family, have an open discussion and chat to figure out what it is you all want as a family before going out to any third person and giving them a mandate or a buy order for anything you're investing into. First, figure that out. From a direct deal standpoint, start to learn how to eliminate. I think the art of saying no is highly underrated. It's something that I myself learned at a much later stage, but I'm happy because now we're able to eliminate through things full well knowing that they may still generate a lot of returns for somebody else. But I think real investing lies in the art of accepting that something you rejected may do well for someone else, but whatever you pick in as an exception would still do well for you. So these are some of the first few things that I would say, and try to cut the noise. I know a lot of investment greats always say this line that investing is a highly personal game and it's a personal battle. At a family office, it's even more personal because it's not just some public money that has come to you with 25 investors writing you 50 checks. This is your family personal wealth. So things are by default a lot more sensitive. Reactions are always amplified. So how do you create a method to the madness? I think that's where the answer lies.
And, I also want to ask, because we discussed this in one of our conversations where, obviously when a wealth creator or the promoter sees drawdowns in their portfolio to the tune of 30-40%, that is something which is not in their control. And they're so used to being able to control things in terms of how it moves in their businesses, right? So to be able to have that level of detachment with your portfolio is also a skill which is learned psychologically, right? Like you have to train your mind to it. So what was that experience like for you?
I've had multiple instances where market drawdowns have absolutely created havoc mentally. Because, when you come to a family office setup every day, you're obviously viewing the markets. 9:15, everyone's money control is open or everyone's getting a call or a message. So in my case, I remember the first drawdown that we had seen was somewhere around 2014, there was a bit of a lack of stability in the market. And then 2018 January, I remember mid and small caps had a large drawdown. Both the situations, I remember the difference of reactions. So 2014, the reaction was more like, what the hell just happened? Is this normal? Should this be happening? 2018, the reaction was, okay, looks like things were a bit heated up, though this was going to happen. 2020 COVID was a real test because I remember I was sitting down with my family in our farmhouse, and that time the drawdown had come in a very sharp manner. And that time, surprisingly, we had stopped reacting. So it started from a cycle of overreacting, reacting to now being numb. Because we said, look, it's COVID. Obviously, markets are going to correct. And I very distinctly remember we had an IC meet in the middle of COVID on a virtual call where we said, okay, we won't buy anything, we won't sell anything. We'll just let things be. You chose not
to buy also.
We said, okay, let's not buy as well, because at that time, I also had to manage psychology. It wasn't just capital, but for us to invest a large sum, of course, in hindsight, it would have done supremely well. But the decision to also not sell or do any panic selling for me was a bigger victory. Because the markets were highly volatile. And, when you're managing family capital one thing becomes very clear. It's not just about creating delta. It's also about handling the family and the emotions and making sure that you don't do rash things.
Yeah.
So for us, we view that as a victory. But of course, the next time that something like this happens, we are going to be far better prepared psychologically also.
Yeah, definitely. So will you be buying in the next bear market?
Oh, 100%. I would love to. I would love to. So in fact, I hope that this market eventually, for the sake of valuations, turns into a
Now I think
prolonged
I
bear
see
market.
a lot of people wishing for a bear market to happen again. So
Yeah.
at least a decent financial correction so that,
So-
we can all
Yeah.
amp up our portfolios.
So true. So
Yeah.
true.
But when you think about, in terms of even the policy framework, in terms of deciding which assets to allocate to, how much to allocate, was that a mutual decision amongst all family members? Or did you as the CIO take the lead on it and decide that, this is how we should do it? Or, was it the IC who formally decided together?
Yeah, it was a highly collaborative effort. Our family office team has always believed in open dialogue and collaboration. The reason we have these kind of collaborations is because, again, balancing emotion with objectivity of returns. So, for example, 2018 was the year our family completely exited from the joint venture, which meant that it was directly the liquidity which has to be allocated. So the first thing we did and sat down on the table was we had a family meet where we had family as well as the folks who had been with us for a while. And we said, look, what do we want with this money, right? What should it do for us? And then we realized that the answer is a number, but the answer is also figuring out what does risk mean to each of us. So for example, for one member, it could have meant capital erosion. For the other member, it may have meant achieving the same IRR, but not in 1 year, but in 2 years. So there were different types of risks we were dealing with. So we had a very collaborative approach. Everybody was absolutely open with their thoughts. And the resultant of that is what led to us deciding the asset allocation. So started with the number, then went to the allocation and said, okay, for example, to achieve X percentage of return, we need to be overweight on equities. And we need to have a higher number towards equities. If it was a different number, the answer may have been slightly more tilted towards debt or treasury. Personally, for us, the answer came out in growth equity. So we are a highly growth allocated family office, and we're almost more than 80% allocated towards equity markets overall. So highly aggressive in that sense. We have high faith in the market, and this is where we want to make our money.
It's not surprising that, it would cause mental havoc if like 80% exposure to equities.
Yeah.
That's very high. So was that because of the family's risk-taking ability at large? Or what were some of the decision factors?
I would say so. It was a mixture of risk-taking abilities which emerged over the years. Because at the initial stages, our equity debt was roughly 40-60. So 40 equity, 60 debt. And as the liquidities increased, and more importantly, markets matured us.
Yeah.
So being in the market, we learned and absorbed a lot. And spending time with great people who are doing this, hearing their podcasts and hearing their videos, that sort of trains your mind to behave in the market. So fortunately for us, that journey was positive. And when I came out of it personally, I was able to be that guiding force for the family to tell them that, look, I understand the concerns, I understand the pains, but my study and my logic tells me this.
Yeah.
And so there has to be some level of faith and sort of an exchange of faith between the members and the team. And that's the moment we decided to say, look, we want to be overweight equities for the very long term, and we don't have to do it overnight.
Right.
And so that's where me and my dad had a lot of discussions that, we don't have to change our mental makeup and allocation in 24 hours. We can do it over 6 months. We can do it over 1 year. So as long as everybody was on the same page and there was comfort, we were okay to execute that.
Yeah, that's very interesting actually, because, I had a discussion with my father because primarily all our net worth was tied in the family businesses, right? And I think that's true for a lot of Indian business families because they didn't have equity portfolios or, even outside investments. So was that true for even you, that, you went from completely being invested in only your business and then diversifying?
That's true. We did invest even during the time of the family business, but as you can imagine, it was never reviewed or seen daily or quarterly.
Yeah.
Maybe once in a quarter, the family would catch up with an advisor or a banker and check in about what's going on. And personally, what was happening for me was during that whole time, I was very much glued on to markets. So I was seeing money control every day. I was reading about companies and stocks. One of the first games I remember playing, there was a stock market game that used to be on the PC.
I know which
right?
one you're
Where
talking
you could
about.
virtually allocate to fake money to
Yeah.
different companies. So I remember I made a portfolio there, and I went and showed my family that, look, guys, I made a stock portfolio, and that made some good money. And when that happened, it sort of opened the eyes of the family to say, hey, there's something here. We could start to invest a lot more actively.
Yeah.
But as you can imagine, the capital was still tied in the business. So we were restricted to a large extent. Primarily, we were doing real estate more than equities before the exit, because that is something everybody immediately understood. But when you want a growth asset and when the liquidity comes to you, then you're forced to change your lens in many ways.
Yeah. And I have to ask you this, since we're on this topic. There have been industry leaders who've been talking about family business, kids not going into operating businesses, but setting up their family offices.
Yeah.
I know we've chatted about this, but what was your take on that? Because, as someone who takes the baton forward in terms of setting up a family office, I personally think that it's a very big responsibility, and you're being a steward of capital in a big way.
Yeah.
And capital preservation is also a big responsibility. So I don't take this responsibility lightly, but I would love to hear your take on it.
Well, my honest take on this is that, look, everyone's entitled to their opinions. Even when we sit on an investment table, you can have 6 different opinions, and that's totally fine. I don't take these words very seriously, because the way I look at myself, to be very frank, the way I look at myself is that I'm a custodian first. This is not capital that was given to me by 50 investors or large funds where I can do a lot of things just in any way that I want. So when you have a custodian mindset, what happens is you immediately start to value the capital preservation part and then focus on the growth. So that's what I tried to incorporate in my line of thought, right? So the idea from my perspective was never to think about, okay, let's pray across 50 companies, or let's take some unknown risks, which we have never done. So we tried our best to make sure, and at a personal level, it was always about custodianship followed by growth. So I think it's a very large responsibility for 2 reasons. One is that this is a wealth that the family created over decades of hard work and sacrifice. And for me, I was privy to a lot of that. I saw a lot of the pains and struggles that they took to create the capital. So it was immediately a responsibility, from a sense that I will be the person to help transition this wealth and create such a solid structure for the next 50 years. Right. And I'm talking about maybe even 50 years is less. When I talk about family wealth, we want it to be 200 years, like some of the older European family offices. So I view that as a very important responsibility. And what I also think a family office does is that within the framework of managing wealth for the family, you also have to find your calling.
Yeah.
So either you find that calling within, or you find that calling in something else. But as long as you find a calling and you're following it with a good intention, it's completely fine. And then people can still keep giving opinions, and you can keep hearing them, which is fine, right?
What is your calling?
My calling has always been financial markets. I've been super passionate about it. I remember distinctly the first time I visited our factory shop floor, I was still glued onto my phone, viewing money control and figuring out at that time, why is the stock going 10% up and down? What's the reason? What is a balance sheet? And I remember I used to spend a lot of my time with our chartered accountant in the factory to sit and figure out, that, okay, this P&L statement, how does this look? This balance sheet, why does it look like this? And for me, I was fortunate enough that I found that calling early on. And then the platform arrived where I could really sit and act as both a custodian as well as a growth-focused mindset.
And you spoke about, private market investing as well. Let's take a segue into that, because, private markets are also something that you need to learn. It's a process. It's art more than science to it, as they say. So what was your journey when you were looking at the private markets compared to the public markets? Because, one can say lesser risk, more liquidity, and, all that in the public market. So there's a lot of pros, right? And we've
Right.
seen that play out in our portfolios also.
Right.
Private markets do come with its cons, like,
Yep.
illiquidity, not knowing where the market will land, and a lot of failure in your portfolio.
Yep.
So you do need a different mindset when you're moving from the public markets to private markets. So what was that journey like for you?
Initially, when we started out, we had no idea about deal flows and where to look for startups to even invest into. So the first step that I took, I think this was around 2015, where I approached a few platforms which were doing crowdfunding and taking in smaller checks from a lot of investors. So that was my first segue into this
The
segment.
syndicates that were running at that point.
Syndicates and platforms. And they had a lot of deals in the tech space, which was still hot then, as much as it is today. So I decided that I'm going to take out a very small experimental capital, try putting in money in these platforms, mainly from a learning standpoint. So to be frank, at that time, return was not paramount. So the idea was that what else can we learn from this investment than just the returns? And over time, started to create and form networks that would eventually lead into getting deals. So today, all the inflows of deals that come on emails or WhatsApp, sometimes it can be overbearing, but it's all a result of so many of events that I had to attend, so many people that I had to meet, had multiple coffees, multiple dinners with different, say, VCs or fellow family office investors like me, where we sat and said, okay, this is what I'm doing. So what you're doing, can we collaborate? Okay, these are my portcos, these are your portcos. So a lot of that had to happen in order for deals to now start coming the way they are. So it took a lot of effort. And we were also LPs in a few funds. And again, the idea there was, how much can we expose ourselves to the ecosystem? Can we attend events and meet other people as well? So we never thought of it always from a venture capitalist mindset only. There was a strategic sense also, because at the end of it, we realized that these businesses could grow into something big. And the strategic standpoint was that, what if the family wants to potentially convert one of these businesses into a project? And so from that mindset, we evolved into saying that, okay, now we will do only few sectors that we really understand and support promoters. And there is an IRR target. So I think that's been the journey so far. And of course, international travels and meeting folks abroad opens up your mind to what else is going on as well. So.
Yeah, absolutely. I think that's everyone's experiences. You do have to put in that effort and time to build relationships in the ecosystem. And then you get flooded. So then you have a different problem to solve, which you were just talking about, dealing with all the inbound that we do end up getting.
So true.
How do you deal with that? I want to know.
Again, we had to sit down at the table. And this is not very far back. Just about a month ago, I sat down with the team and said, look, we are now getting quite a few deals every month. What do we do? So the first...
And not just direct deals, right? Like even investments in funds as LPs. That has exploded.
That's right. That's so true. That's so true. And now we're seeing many more funds entering the space. So usually what happens is, when these discussions start internally, the team always comes back and asks me first, right? That, okay, what are your goals? What do you want to do with these companies? Is there a strategic thoughts process, or are you just looking to earn an IRR? So today where we stand, we are decided that we want to focus on only a few sectors in the private space, and we want to completely avoid the rest, because that is a risk that we wish to not take knowingly. And now we have a pretty solid MIS built in our backend. So a lot of the deals that come through, they come in a certain templatized format. And because we use some really good interactive platforms between each other as teams, we're able to immediately say no to a lot of things first. And then whatever remains, we take it fairly slowly. The other thing with deals is, they come with this timeline, and that, it's going to close out in a month or 20 days. So we try to...
24 hours.
24 hours.
What are you talking about?
So we try not to get into that rat race of trying to close a deal, because we don't want to compromise on our IPS. Every time we have thought of, even for a split second, compromising on something, it's never led to a good, either an outcome or a thought. So now it's like saying, hey, we're taking a back seat. If the deal stays, it stays. If it doesn't, it's fine. We'll find something else. So having that open mindset has helped me eliminate a lot of things. And for the private space, we focus a lot on consumer brands. That is something where I'm personally very passionate about. Having seen a piping consumer brand being built up in front of me, that is something I'm passionate about, and the fintech space because of my time in finance.
So these are the two sectors that you're looking to invest in.
Broadly. Of course,
in
there are
direct deals and
exceptions.
also funds.
Yes, broadly. There are exceptions that we make, of course. For example, something like space tech, hypothetically, if we were to allocate, then I'm not sure I would want to do deals by myself. I would like to have a team and a solid setup which is guiding me. So we've been able to decide now what we want to do with our hands and what others can do with their hands.
Yeah, because fintech and consumer brands in itself are very deep sectors, right? So you can see a volume of deals still. The problem that I also deal with is that the deal quality is actually improved significantly, right? Like earlier, you could say automatic no to a lot of the deals that were coming, but I think the founder quality and even how polished the pitches have gotten in terms of, founders knowing so much, given that, there's a lot of learning in the ecosystem, there's a lot of learning from seasoned entrepreneurs who are coming back to build. So it's become harder to assess for quality just on email. So you kind of do have to, take the first few calls or, have a conversation to be able to really understand. So I think the deal quality improving, which is a net positive for everyone, is actually like it does affect your decision making at large. So what is your process around
Definitely. I mean, look, deal quality for us, I would say, has been an ascending order. The first few years, I wasn't even sure what we're getting is legit or not. And when I say legit, it means, is it investable or is it just something that's like a leftover that's coming to you?
Because that's what a lot of people thought also, that whatever deals don't get subscribed, they go to family offices.
It's true. So I have a friend, we keep joking about this, and we always say that anytime anyone approaches us with a deal, the first reaction is, how come it came here? And almost always the paranoia is that it's come because it's a leftover. Having said that, I think as a family office investor, the more clear you are with your thesis and you can communicate it to the market, then you will immediately start to get better things. Because if you don't communicate, then the same 5 things are going to keep showing up. So it's important to also say no to those deals and be able to communicate to the market that, look, these are the sectors we're focusing on. This is what we want. And deal quality, to be frank, what me and my family always say, deal quality is ki paisa bana ki nahi. So agar paisa bana, to deal quality is good. And if you didn't make money, then, well, you may have been meeting really great people, but you didn't make money. So it's basically as simple as that.
You're not there to meet people ultimately. Ultimately, you have to show it in IRR. So what is, like, if you want to share, what is that internal IRR target? Because, it's different for each asset class, right? In private markets, it's usually pegged at higher, but historically, or at least like last few years, the fund performances were not really tracking up to that, right? Like they were not meeting the benchmarks. Some of them were, but not most of the funds in the market, which is true in every private market around the world. But there was a little bit of that. So how do you keep tracking IRRs in a space which you can't really do yearly? You have to kind of wait it out and see and live through the cycle.
Yeah, no, absolutely. So for the fund investments that we do, where we take positions as LPs, the base expectation is that they have to beat our listed equity returns for sure. And that becomes a benchmark. And when I say listed, I would compare the return profiles to that of a mid or a small cap fund in terms of the risk. So I would even go so far as to say that the reason we invest into venture capital and funds or deals is so that we earn a premium. At least that's our mindset. And if we cannot achieve that, or if I'm getting returns similar to a listed instrument or a mutual fund or a PMS, then it's no longer doing what I wanted it to do, unless I have a strategic reason, in which case it's a very different outcome. You're not capturing returns. So for us, it's a very simple goal. At a very base level, I'm saying, without any rules here, but more than we expect at least a 30% IRR with direct deals or even with fund investments at a net level, not even gross. So if that is not achieved, then often, and then we could argue that listed market funds could be compared in a different time horizon, but it has to beat that, because why else are we taking such an added level of risk where valuations are not clear, where you often have to wait for a quarterly update from a fund or a company, and compared to the listed markets where you open your phone and you see the whole P&L. So for us, that is the risk return that fits into our profile.
Yeah, because one would argue like in the last 2-3 years, like your small caps and mid caps gave 30-40%. So which funds in the private space were meeting that criteria,
Yeah,
right?
yeah.
So then how does one decide when one should do private versus public?
So
it's
true,
not
so
very
true.
it's not a very straightforward answer.
So true. Yeah. And market cycles, I think, create a lot of opinions. So
Yeah.
2021 onwards, when the PE market bubble began, at that point of time, every conversation I was having with networks of friends was that, we have to allocate to private equity, we have to have venture capital. And suddenly no one was talking about listed equities anymore.
Yeah.
And now in the last 2 years, everyone's coming up to you and saying, hey, so we made a lot of money in small caps. So what's the need to do venture capital?
Yeah.
So I think somewhere the answer lies in the balance. So it's important for family offices like us to never get swayed by the bubble or the ebb.
Yeah.
And just keep on allocating without overthinking on what's happening in a short-term period. I think that's the only way to achieve mental stability.
Yeah, because
like
I'm
these.
asking this to inform a lot of fund managers who are out in the market raising from family offices, so that they also get an insight into understanding what really goes on in the minds of decision makers at family offices, right? Like, and these are the options, because these are the questions we ask fund managers also when we meet them, right? So when you're evaluating a fund manager, what are the things you're looking for?
Well, when we're evaluating a fund manager, it always becomes about the quality of the person we're dealing with, and at a broader level, the group of people we're dealing with. Because look, when we allocate and cut a check to a venture capital fund,
it could also be public markets, by the way, like, in that sense. Like, I'm talking about the broader spectrum of fund managers.
Right. So if I take into account VC fund managers, listed markets, or even AIFs where they have specialized structures, I would say the reason we're cutting a check to them is because we can't do it. And that comes with a lot of trust that the fund has to deliver eventually. And more importantly, how well are they managing risk? Because that's the other reason why many people decide to not purchase small and micro cap stocks.
Yeah.
They say that we will allocate this to a fund manager. But the reason they do that is they are controlling the beta. They are able to make certain things happen which even you could not as a family office at times, unless you're highly you have your own setup and you have 50 guys working
which
there.
Which barely anyone does, all the new crops of family offices at least.
Right. So when you're allocating, it just becomes all about who you're working with, why you're doing this. Because look, the structures are all the same. Everyone's following, at least in the VC world, a 10-year fund for the most cases.
Yeah.
In a listed fund, there's no timeline, but the question becomes about entry and exit for you. And while every fund manager would want that you stay invested as long, at a family office level, you also have to have clarity that are we okay to start pairing off positions? Are we okay to start adding them? Because that's the only thing you have in control.
Yeah.
Apart from cutting a check and taking it out, between that, everything that happens, you have absolutely no control over.
How do you decide that? When to exit position?
So
very curious.
So in the listed fund space, it becomes easier because they are without any lock-ins. There, it's purely mathematical, and we try to follow market cycles. So if, let's say, a fund has over a period of, let's say, hypothetically 5 years, that we keep at that as a basic benchmark. So above 5 years, if a fund has achieved X percentage of returns, we decide to start pairing off the position. Because also by then, that one fund or a PMS has also become, let's say, more than 30% of my entire allocation, which from a risk standpoint is maybe not okay with us. Maybe another family office is okay with it, but these are some hygiene that we have. And same could be for a mutual fund. It's done extraordinarily well. And from a 10% position, it's now at a 40% position of your whole exposure. So those are the times where we really take an active sell call and reallocate. And have we sat on cash before? The answer is yes. There have been times where we've created almost a 50 to 60% cash position before important events like, say, a large-scale election or a large-scale geopolitical situation emerging.
In the recent elections?
Recent elections, we were invested. But at a personal level, the portfolio that I manage in the mid and small cap
Yeah.
side, we created a fairly large amount of cash, almost 40%.
Hmm.
And this was when the market had just began to start tanking.
Yeah.
And we're fine with it. We're still holding on to it because this is a time I think we will do our homework and deep study before really allocating a bigger sum to anything. So
Yeah.
it's very situational, but we do it. And this is why we are an active family office. So we haven't just always left it up to the products. We take these calls every week. We have a sort of a meeting in a turbulent market. Every month we have a review where valuations are discussed. Nifty 1 year forward PE. A lot of our investments are based on the entry and exit level valuations. And for direct investments, as you can imagine, we create financial models. We do our research at a primary level. So we try to be as process and research led and not only from a family wanting to do something standpoint.
Yeah, very interesting because every family's dynamic is so different in terms of how they decide also. But coming back to the question about fund managers in the private space, there's this whole new crop of GPs who are very operator heavy, right? Like they've built businesses before and now are coming to build their investment VC business. So what is your lens of evaluating those kind of operators who are now turning into VCs? Because there's been a new wave which has come up in the market.
Yeah, I think that's a great idea.
Yeah.
Personally, I look at that as a huge positive, more from the entrepreneur side than even the family offices, because what really early stage founders need is true guidance from people who have been there and done that. For example, if let's say my family were to guide a new business in the same sector and they were to seed fund them, I'm very sure that business would always like to take capital from them versus somebody who's not had an experience and all they're coming in with is a check and say a hand-holding mechanism to get them on for 10 years. So operators turning that is for me very positive, and operators, one operator understands another operator. So when they come and talk to us, there is a whole other vibe of understanding why they're doing this. And I've personally had many conversations with operator-turned-VCs, and it's always been very positive, and they have a very unique perspective on problem solving with early stage companies.
I think they are very hands-on and it comes across in conversations, right? Like, and they also enjoy working with family offices because of the operating business DNA that we come from. So it's a very mutual kind of beneficial relationship in that sense.
Yeah.
And going back to the public markets, because, you do have exposure even outside of India. So let's talk about that, because even that is a learning curve for anyone who's building a family office. In our case, we do India and US, but it took a while for us to put it together. What was your experience?
Yeah, so for the global investment side, this was a personal initiative that I took for the family office. Again, as you can imagine, this was in 2014, just 1 year after the first exit. So at that point of time, we were still getting accustomed to Indian markets. And I decided to jump the ship and say, we need to now invest globally also in dollars. And so that of course, it took some time for me to get the family on the same boat and think about global allocation.
So did you start small or did you go with large?
I started very small.
Okay.
So my idea was to get a taste of things, because my general style of working, I don't like to overcommit capital at the initial stage. So I call it R&D. So I took a small R&D budget from the family office and I said that, look, I'm going to be responsible for this capital. So let me allocate it the way I think it is. So we started to initially use LRS to start to push funds out. And at that time, I was only doing US markets and some bits of European markets. And I was also looking at China markets at that point of time without investing. So for the US markets, we mainly did True Blue ETFs for index funds. That's how I began. And then I started to go into stock picking based on, say, global research reports and my networks and friends in the US and Europe. As you can imagine, initially very difficult because I was also at a learning stage. So getting data, getting the right insights was difficult. Over time, as we kept doing this exercise yearly, and I think more important than the funds was all the events I went for and people I met. That's where I really thought my personal intellectual curve was heading upwards. So,
like, give a few examples.
Yeah, so I think a good example is I remember attending an event in Geneva where for the first time I met European family offices who had individually been around for at a minimum of 80 to 100 years.
Yeah, they run through 10, 15 generations also, right? Which is so interesting to see because
Yeah.
that's what true institutionalization of capital is.
Yeah. And for me to see that firsthand, and I remember talking to an 82-year-old Polish gentleman who was the patriarch of his family office, and he, I believe, was a part of a fourth generation, family office. And we managed to get a long conversation over a drink in Geneva. And he told me his whole journey about how this wealth was created, the fourth generation, and how he's spending his time now. For the first time, my eyes opened to the world of saying, because in that part of the world, wealth has been existing for a slightly longer amount of time.
Yeah.
And so the number of first world problems that you encounter there are a little more compared to India.
Yeah.
And but of course, in a positive light, I tried my best to learn from all of these interactions and figure out, how do you create an institution rather than only a portfolio allocation for, say, achieving 2% delta.
Yeah.
So I started to look at it from the sense that how can we create an institution that can outlast and outlive us and become so solidified. So this was one conversation. And of course, I met many others my age.
What were some of the best learnings from these, like best practices that you were able to learn?
So the first practice that I was introduced to was having a family retreat. In India, we call that a family vacation. But a family retreat was introduced to me by a friend who has her family office from the Southeast Asia part of the world, where she mentioned that every year, semi-annually, they head out and the family goes with an agenda to go to a really far off hotel or a resort where it's only them. And they sort of, it's kind of like a board meeting where they sit and talk about things that are going on in their lives.
Like an offsite.
Right? So everyone's hanging around talking about what's going on in my life, what do I want to do at a personal level, what are their goals from the capital, and most importantly, what they are trying to achieve as a group and individually. So the first time I heard about this, I realized, hey, a lot of these conversations happen in India at homes or in offices, but going to a retreat just sort of changes your entire mindscape and you're relaxed.
Yeah.
And I think this is a beautiful practice because it encourages you to think, and end of the day, a family office is for the family. So if they are not being addressed, then, so retreat was a great example. The second thing that I picked up was how to start viewing alternative assets and globalizing your wealth. So a lot of the family office gens that I spoke to were doing a lot of investment in things like art and a lot of investment in things like antiques. Now, it didn't mean that I wanted to go and suddenly switch up my allocation, but it opened my eyes to the fact that value can be held in very unique and multiple asset classes, and globalizing the wealth, which meant that all of these folks who I spoke to, they had some sort of a base abroad, whether it was a city or it was an apartment or an office. And that really taught me the importance of thinking of family wealth at a global level and not just
because
about
a lot
India.
of people have structures now in Singapore, Dubai, or the US. I think that's becoming the norm.
Totally.
But what was that thought process for you? Because that is also a hit and miss kind of situation, right? You need to get it right. You need to talk to a lot of advisors to be able to get it right.
Yeah. So it was the same learning curve. How I had to sort of build up my curve here in India. Abroad, I had to do the same thing. Go out, meet folks in the ecosystem. The first thought about diversification was that, okay, we want to diversify INR investments into US dollars. So now you're hedging a currency risk, and now your money is getting exposed to a lot of other stocks and markets. But that objective quickly turned into, how do we create a safety net for the family, not only within the confines of India, but, life is uncertain. The world is uncertain. How do we create a platform that, God forbid anything should happen, the future generations and the future wealth holders should have options available. This could be an investment setup, this could be a business, it could be just assets that are held abroad. And again, these were very open discussions. I don't think we had answers on day one. But as time went by, we started to realize what our goal is. At a personal level, since I'm an active investor, my goal became about having a base where I could look at various other asset classes from and be able to expand the team. So that was my personal goal.
Yeah.
But maybe for somebody else, they would have had a different set of objectives.
So what's your current setup now?
Yeah. So our current setup is in Bangalore. We are headquartered here in Bangalore, and the team consists of a front and back office team. The back office team is primarily taking care of all the day-to-day admin, finance, expense management, concierge. And in the front end, we have complete research and analysis, which I head along with my team. And our team has been very supportive. They have been very understanding of our investment decisions also. And most importantly, 2018 was the year we had the complete exit from the joint venture.
Yeah.
And so it's been about 7 years since we fully professionalized and brought about hardcore systems and processes into the family office setup. So the division that I head within the family office, to be specific, is the direct investment side, where I do active investments towards mid, small, and micro cap companies with primary research. And we work with various channels in the market and consortiums. And on the other front, I am still very active in private equity. However, our thesis there has seen an evolution. Earlier, we were doing only seed stage companies and funds.
Now like a lot of family offices start with, right?
That's right.
Because we know how to build businesses, we can take them from seed up to IPO, is the common belief that people started with.
That's true. So we still do some of that, but now the focus is centered towards specific sectors and stages. And again, there we have a portfolio approach, which again is actively managed with me and my team. There are many market participants that we work with, people who advise us, and a very solid network of fellow investors who we are constantly sharing ideas and exchanging thoughts with. So this is the specific segment which I am sort of taking the lead on.
Got it. And because there are lots of new multi-family offices also. So one question one has to think about: do you build your team in-house, or do you outsource a lot of the thinking part to the multifamily offices? Any thoughts on that broadly?
My personal take on this topic is that any association can be only as good as the people who require it. So the way I look at this is that, in the last 4 to 5 years, I have received multiple outreaches from friends, from certain family, and various people saying they want to actively invest and set up a family office. But my only advice to certain founders is that, look, it's very possible, and I think it's a very healthy thing to contemplate. But if you're spending time in other projects, and if you're spending your passion in other projects, then this is not something that needs to be done in-house. That's the time you could definitely go to a multifamily office or wealth advisors or multiple types of associations in the market. So, and that's also my advice to them, that you don't have to do everything. And if it's a passion, then you must 100% do it. In my case, I was lucky that it was both my passion and the platform existed. So today, a lot of what we do, it just sort of comes to us naturally. But a lot of multifamily offices and wealth advisors can play an equivalently good role for new founders creating wealth. But it's a very personal call. So I try not to dole out too much advice to folks.
But
so
just one thing to keep in mind is that it's also very expensive to build your own team, right? Versus, going to advisors who have professional teams to do it. It also depends on the involvement from the family side, I think. Because, if someone wants to take the charter ahead and be very actively involved, it's very different to just handing it off to professionals to run it.
So true. And I completely agree. The cost factor, as you rightly said, it's highly important. Your even with a 5 or 6 member team, the cost can balloon up very quickly. Because in the family office segment, compensations have now started to be linked with a lot of variable components and outcomes. So that is something important to consider. And not to forget that even if without a team, there are a lot of hidden charges and expenses you are still occurring, right? Your brokerage fees, your advisory fees, the kind of commissions that are paid on products. So if you actually take out a P&L of a family office without a team, there are already a lot of expense items. And now when you add a team, the expense suddenly starts to balloon up. So it's really about passion and involvement.
And that too without a cash flow business on the side. So, it becomes a little challenging, because that is a real challenge when you're building a family office
very
also.
True.
And, when, especially in the first 2-3 years where people are not very sure of which direction to take, I think you can save a lot of costs by getting the right professional help and then see how it evolves.
Absolutely. And if I can give a small example. I recently met someone here in Bangalore who I met at a coffee shop, and this person had just created a bit of liquidity by selling their ESOPs in a company, and they had actively reached out saying, "Hey, so you run your family office, and I've we've come to know each other, and I would really like to understand how do I set this up and that up." And within the 10 minutes of us starting to talk, after discussing the costs and the kind of processes needed, I could immediately sense that their interest immediately waned off.
Yeah.
And the only thing the only advice that I left with was, look, you don't have to do everything. And if you can't, it's totally fine, because human beings are not all meant to do the same thing. So he finally agreed that he would go and speak to a few other advisors and folks.
Yeah.
And I myself helped with a few advices in that front. So what I'm trying to say is that there is a lot of interest and a lot of passion there, and yet you have to be rational about decisions.
Yeah, because it's not as simple as just having a conversation in a coffee shop or a
Yeah.
gym, because you ultimately have to live
Yeah.
with the family office and grow it over a period of time. So when
That's
it
true.
comes to thinking through like building an institution for 200 years,
Yeah.
how does one do that?
Tough question. I'm still finding answers to that as
Yeah.
we speak.
But where are you now in the journey? Like what are some of the factors you're putting in place to be able to build that institution?
So the first thing that we're trying to bring in is, can we be system oriented? But it's difficult because there's so many emotions running in a family office. And I don't think you can ever cull the emotions, no matter
Yeah.
what you say, no matter how professional everyone tries to sound in, interactions
Because
or
it's
events.
humans at the end of the day
You're
you're
dealing with
dealing with.
people, right?
And that
So
too with money.
yeah.
So greed, fear,
Yeah.
all those emotions
Yeah.
play into the mix.
They're
right?
always going to come and go,
Yeah.
and you're so right. So what we're trying to do now is create certain systems that are at such a high level that even we have to think about implementing them for forever. And that rule applies to everybody, right from the family principal to the accountant. That whole spectrum, everybody has to follow it. And only when we create systems like these can we create a process which then becomes a habit. So
Give me an example.
so a good example is a review mechanism. Now, it's an easy thing to say that, okay, you open your portfolio once a month and discuss about it. But what are you discussing? What should you be discussing? And what is actually critical to be discussed? These are three very different overlaps,
Yeah.
which don't tend to happen very often. So admittedly, so in our first year or so of investing in 2012, we were mainly focusing on only equity markets, right? That, okay, markets are up this much, what do we do? Down this much, what do we do?
Yeah.
Fast forward to today, we are now talking about things at a far broader level than just markets. So we're actually sitting and discussing about, okay, what are we reviewing in terms of, say, the structures for succession planning? What are we reviewing and discussing for global investing? What are the, say, other assets that we are trying to keep track of? What kind of softwares are we using internally to improve our efficiency?
Yeah.
So immediately we can see a huge change in the kind of discussions that we're having now. We are still getting there, but today, for a 200-year-old institutional target, for that we have to be highly, highly system led. And personally, I think that a family touch is always needed.
Yeah.
It's very difficult to fully outsource something like this, because the trust element in a family is of course at a very different level. Not taking away anything from professional teams and people. I
Yeah.
think they add tremendous value, but if they can be thought of as family, then it's a perfect marriage.
Would you go in the direction of raising external capital?
That's a very interesting
Because
question.
that's how a lot of family offices evolve, right?
Yeah.
They start from their own family's wealth and then they go out and raise several funds
Yeah.
or whatever different structures.
Yeah. So the way I look at this is, I like to keep these things serendipitous. If they ever come our way because of the work we do, and if the market looks at us with those lenses, why not? It's fairly serendipitous. I like to say never. So we will of course take things as they go, but our goal will always be to be as true to us and as true to everybody else out there.
Yash, also, when a lot of people are doing direct investments in listed entities now, because everyone suddenly is a stock picker,
Yeah.
and people don't fully appreciate what it really goes into being able to identify the right stocks, right? Like some of the people I've had on the show have been doing it for 30, 40 years.
Yeah.
And even then they are humble enough to say that I don't know enough.
Yeah.
Whereas, a lot of family office kids, or not only family office kids, but I would say broadly, I think the younger generation thinks that, they know how to select individual stocks and they can get it right. So let's talk about, how you decide which stocks to go after, where to make direct investments, and how did you build that process?
Right. So I'm actually a huge fan of some of the earlier guests that you've had. And so the first thing that I've learned from them is humility, to know that sometimes you don't know, and it's totally fine. So the way we started, and which I started, was first it was a stock market game. That's how it started off, to think about allocation and stock picking. Over the years, what I started to do was I started to take out certain capital from the family office and manage it independently, which meant that the picks of buying and selling were completely my own. So there was no oversight on it. There was nobody telling me also what to do. And whether a decision was good or bad, I just had to live with it, even if it meant capital erosion. So having seen my own journey of up and down there, I came to a stage where I decided that now, for me to really take this to the next level, I will have to start incorporating thoughts and practices of the greats. So, read a bunch of books around this, met a bunch of folks to discuss this. And the outcome of this was to again create a system. So can you create a filter and a process by which you can again start to sift out companies that meet certain criteria? The general conception that today folks have for investing in direct equity is, you're talking about 20% plus ROCE companies, 15% ROIC companies, companies with 20% year-on-year sales growth. So these are the general parameters that a lot of us just talk about.
Yeah.
But many times we don't realize that some of the very good companies may not initially fit these criteria, and they might take time to evolve. So that's been a big learning, is to not be fully bound by metrics and science only. Because if it was that easy, then everybody would be making money, right?
Yeah.
So I decided that I would approach it as an art. So an art is something that you learn by doing and understanding. So I was fortunate enough that the family office trusted me with the capital. And fast forward to today, what started out in 2016 as a small portfolio that I was managing has now grown. And I'm happy to say that in many of the markets, we have hit fairly solid numbers, which gave us a lot more confidence and impetus to say, okay, we can do this as long as we continue to be process oriented, not overreact, and be humble about the markets, and realize that sometimes you could pick the best stock, it still may not do well for 20 reasons. So that's been our journey in direct investing.
Yeah, I think, that's everyone's journey. You have to learn through a lot of misses and errors along the way. But I think, Yash, you are a representation of what's really happening in the family office wave, where I feel like your family office is one of the few which is actually thinking about these processes and institutionalizing it from a very early stage, I would still say, because it's still, you're a decade into the journey. But there's so much inspiration that other family offices will draw from this. So thank you for coming on today and sharing these insights. It's been a fabulous conversation, and I hope other people benefit from it.
Thank you very much for having me.